Matt, pleasure to connect. Managing director, Tectonic Ventures. You founded it. You have a fascinating background. There's very few people that started with computer science, then moved to a PhD in economics, and then have taught at both HBS and Sloan. So I am both impressed, but also excited to learn like where you're spending your time now, because there's almost any avenue of pursuit that you could be in. So with all the option value in the world, like what are you exploring today?
So I spend my time both heavily at MIT, where I'm still a professor, and I teach. I teach entrepreneurial finance class, a venture capital class, and FinTech. But also really spend a lot of time on Tectonic Ventures with my team, looking at new companies, but mostly we spend a lot of time helping our current companies. So
yeah, and Tectonic is really on the edge. You guys are investing in companies that are not doing vanilla type of work, but really pushing the edge of innovation, which I find very fascinating. Where do you see what the work you're doing at Tectonic and how that might relate to what your background is in FinTech?
So we do invest in FinTech, although it's not the only thing we invest in. It's really, my background is about economics at its core.
Yeah.
I have a PhD in game theory and then spent a while as a finance professor. So it really, it makes me at the end of the day look at our investments in a particular way. Mm-hmm. So they are a technological solution to a tough business problem, but we spend less of our time trying to figure out, is the technology amazing? People are usually like, oh, don't you spend all your time trying to it's like, no, we're here at MIT and Harvard and we know lots of professors and interesting people. So it's pretty quickly for us to sort of ask around and find, okay, the technology's cool. So that's not where we spend that much of our time. We really spend almost all of it on the economic side.
Yeah.
How do we think this market, this new area, whatever we're in, how will the pricing, the market, the demand for the product, all these kind of things, how will this work out over time, which really gets back to the economics of it.
So if you take a first principles approach here on a question that all the public market analysts are asking, right? Like things around like, what is the depreciation on training a net new foundation model, right? Like this is going to drastically drive the market cap of the publics, but it's also going to drastically drive the individual decisions that you guys are making at Tectonic. So like, how do you guys think about these huge capital expenditures into these foundation level of AI and like what that might mean from a returns perspective?
So the foundation models from the beginning have been like a super tough area for us, because
you were out.
No, not out.
Okay, all right.
Because in some sense, like out's the wrong idea for a cutting-edge technology firm. It's trying to understand as best as possible into a new world.
Yeah.
What is likely, or even not even likely, because likely suggests greater than 50% odds.
Right.
What is possible?
Yeah.
Way, and then we take more than one bet.
Right.
And so the LLMs, I think there's a world where they're just almost free, where people give them away in order to make money in other ways, and there's a world where there are niche ones that are super valuable, or one begins to dominate, like Google. I mean, you can do this in the search engine world.
Right.
Search engines used to be, and then there were a million of them. And obviously David Cowan famously tried to get out of the house where Google was without meeting them. Like, please, can I get out of here without meeting them? Who wanted another search engine? That turned out to be the best. Are we going to get one that dominates? Are we going to get many specialized? Are the big boys going to give them away for free so that they can make money on compute or something? So we don't know. A lot of options, but ours is not to sit quietly on the sideline. It's to
I mean, you have to express an opinion with capital, right? Like, and so is it like, great, we're going to do two pure LLM, two SLM, two stage-based models. Like, how are you guys expressing that opinion vis-a-vis investments?
At the end of the day, we're a little weird in a sense. A lot of people, particularly if you're a very large venture capital firm, you kind of have like a top-down thesis of we're going to invest in a chip for AI, okay, and then you got to go learn about every single one. We're very much seed stage. In some sense, the bottom, the earliest. Everything we do is about our network, about who we can get to and who we can help. So out of the MIT, Harvard, also on the board down at Duke, I taught at Columbia, out of this network of everybody we've helped for a lot of years, things emerge. And when when they do, and that we get to them for the right reasons, we can really help them. We know why we're in the deal, right? Why us?
Yeah.
Very important.
Critical.
Then we say, all right, now we need to figure out. So we do have one. We have something in hardware that's, a new AI chip. We have an LLM. It's specialized, so you can explain. Try to, going for explainability. It's got a particular niche. We have application layer, but it's not that came from a top-down analysis of all LLMs, and then it's more. This is a great team working on an interesting thing. There is a good economic justification,
right?
That may or may not play out. We might be wrong.
Right. You guys have a small enough, and I don't mean in the bad way. I mean that's in a very like entrepreneur friendly way, where your guys' AUM, you're not deploying $1 billion of AUM, right? You guys are involved. You guys are thoughtful about who you partner with. It's not a check a week, or maybe it is, but like it's a much more intimate relationship with these folks.
We're very concentrated. It's one of the things I find laughably funny about what I do is that I will only invest in things that are potentially highly, crazily scalable.
Of course.
And what I do every day is like the least scalable thing on earth. I can only make like 3-4 investments a year. I have to work with them all the time. It's all super manual, all this hands on everything. So totally unscalable, but a lot of fun.
Yeah, I mean that is the cottage industry, that is venture, that has almost been productized for some firms, but I think the original folks that were taking a cottage approach will probably have the best, the top decile returns, if you will. So if you were to take a top-down approach, right? Like if you had to think about value accrual, so much of it is coming to the chip layer at this point, which no one thought 5 years ago, or if they did, they're rich, I guess. But so where do you see maybe over a shorter term time horizon a lot of the value accrual? There, I think 12 months ago the consensus was, these foundation models are going to be like cloud and just be able to, 3 or 4. And I think there's been a shift in sentiment towards the application layer being able to capture a lot of value. So curious where you net out on this.
I do think the application layer will capture a lot of value because as we've seen the progression within our startups and things we're looking at, that I think people had this original view that what we were going to do was have situations where we could ask the AI, poof, and that was going to be the solution. And so a bunch of companies started that were like, all we basically do is ask the AI and then answer the question. And of course, there's not much value there, so we didn't invest in those. And of course, in some sense, that will be subsumed by the AI. What it turns out is that it's much more complicated to actually make something great, and that there is software. The analogy I started using is like everybody has access to Python, so like that's not a barrier, right? You use Python if you know. But some people code really well and they code amazing things, and other people can code all day long and they get nothing. And everyone has access to large language models now. Some of them open source and free. Yeah. But that in some sense, okay, that's the beginning. The real question is, can you put it all together in particularly in these coordinated ways where they're essentially you ask the question, then you ask a different LLM or the same LLM, look at the answer. What do you think? What are the problems? Now you ask it look at it a different way. You got to put all that together. The ability to do that extremely well while combining it with the other aspects of software that have always been there and are not going away is really where we're some amazing products. And the reason they'll capture value in the long run is from the economic reason that things have always captured value. LinkedIn captures value because of a network effect, not because their coding for LinkedIn is so amazing. It's a wonderful. So people will build things using LLMs and other coding, and they will have a network effect, and then everybody will want to be on the same one, and those will be.
I mean, maybe yes. Like, do you think that only because things have a network effect, they're able to capture value like that? I don't think that captures the sort of B2B SaaS rise over the last 15 years.
No, there are other. I mean, barrier to entry. I use network effect as kind of the cleanest, most powerful sort of long run barrier to entry. And all of the great tech firms all have it, right? Like, if you're going to be an $80 billion firm, right, you've got some crazy network effects going on, almost certainly. Or maybe even certainly. We could go all the way to 100%. But there are certainly other barriers to entry.
And so in a part, the advice is the same as it always has been, which is great product on top of existing technology to serve a customer with an unmet need. So what is different about delivering a great product with a probabilistic computer, which is what we have, versus a deterministic computer?
A lot of weirdness. I mean, in terms of like even like it's why that one LLM is more up explainability route. Because how do you even decode, right? Like what do you mean? Like how do you figure out what's wrong, and how do you change your code when you're getting sort of random, some randomness in your answers?
Yeah.
It's not even clear what that means. So we're going to need obviously more explainability. You have to figure out a way to deal with answers that are random and still provide a great product.
Yeah.
We're working with some, in some FinTech areas where we need to respond to people, and the answers are regulated. You can't just say what you want. It's a detail, but a really important one. And so like we have to have ways where we sort of take the LLM answer and put it back through a filter that's checking with regulated answers and then saying, okay, this is actually an okay answer. It's that kind of coordination that we're going to need. And so that's going to be the great ones are going to emerge that can deal with that. We're sort of calling it the last mile problem now, right?
Yeah. Which is the hardest mile.
Right. The last mile is the hardest, right?
Yeah.
And so this is in delivery of LLMs. Getting something that works like pretty darn good takes like 5 minutes.
Yeah.
Getting something that works is possibly impossible, right? Like there's some situations where you just can't do it.
Yeah. So let's talk about these finance use cases that you're seeing that are quite exciting. Like this is unlocking completely new opportunity, often within middle layer. And so we'd love to see the opportunities that you're seeing specific to finance around LLM applications.
Yeah, I can talk about a couple of them. So one, if you high net worths. So a lot of our things focus on the high net worth manager market in that world. You're a high net worth manager. You have a bunch of high net worths that follow you. You want to get into private equity. Okay, that's like it's a giant wave. It's going on everywhere. How do we get you in? In order to do that, you have to understand the opportunities available and then explain them to a bunch of people. Good luck. So this is well, it sounds like learning could be really important here, where we could have not just an LLM. It's not so easy to just say, stick the information into an LLM. That's the part where that'll work okay, not great, never pass regulatory. But how can you actually gather a ton of information, provide it in a digestible way for the high net worth manager so they understand what's available right now. Tell me about that strategy. Tell me how private equity works. The money's called down slowly. What do you mean? I mean, there's a million questions around fees. Make sure the manager understands. Make sure the manager can explain it, right? And if the question comes up that they don't know the answer to, it sounds like an LLM can answer that question. Again, in a regulatory sound way, so not so easy, but definitely something they could do. And then beautifully at the end, actually execute. So when you say, okay, we want to put this person into that fund, great, thank you very much. We're done. We've got done is a strong word, but we've gathered all of it together. We helped you do it. It made it super easy for you to fill out the paperwork. Which, if you've ever tried to fill out paperwork for a new fund, is sort of a horrific process where you can ask crazy questions from the government that don't make any sense. So that kind of end to end. We know we have a demand from the high net worth to put money in private equity, a demand from the manager to help those people put them into private equity, but they can't do it. But it's an information problem and a problem that right now is only being tapped into by sort of the biggest, largest, like Goldman Sachs and put their people. But all the other high net worth managers are out, and it's okay. Well, there's an opportunity, and it's one that is kind of only unlocked with an LLM being able to deal with all the questions you're having as you're moving through the process.
That's interesting, because you think about the jobs to be done at the highest level, right? Their fee structure can just support humans to do the jobs to be done, which is education, paperwork, administrative burden. And as soon as you start to move AUM down, you can't have somebody that just all day answers the phone and hits down the middle, for softballs to say, oh, of course, this is how it works.
Silly questions, again, all the different, you can't do it. Suddenly we can. So that's a great example.
So how do you see that example playing out in the market, right? How low from an AUM perspective could you really get to be offering? Like it completely shifts the market.
It does. So in theory, you could go all the way to like individuals. I don't actually think we're getting there anytime soon. I think because we are dealing with generally relatively high net worth people.
Yeah.
I think generally high net worth people, at the end of the day, what does your money manager do for you? It is not that they pick wonderful investments for you, okay? Because if they were so amazing at that, they'd be a lot wealthier doing something else. It's that they help you understand the financial world. They help you understand like how much house you can afford, your insurance. I mean, they do a lot. But one of the core things is they help you feel asleep at night and feel good that my money is somehow being done correctly. So there is a high net worth manager in the world that I think is going to sit between most money and these kinds of decisions. So I still think it's like at that level, not all the way to like, hey, an individual has a couple of quick questions and then throws $5 into, the latest private equity firm. I don't think we're going there. But you could definitely get down to where you're collecting, relatively small. Oh, I'm going to make a $25,000 investment to that, and the paperwork and questions and the whole thing is sort of dealt with.
And it could be true that the value delivered is only really the specific human value that only that manager could do. So the best managers might actually be the people that are the best pseudo therapists when someone's worried about their finances, right? To just say, hey, stay in the market, right? And so like,
yes, stay in the market. Don't exit now. This is going to work out okay. And then like, how do you shift your portfolio? It's definitely a therapy kind of, and then helping you with real questions. How much house can I afford? Or how big should my country house be? Or whatever.
Yeah. But those are relatively, reasonably deterministic. So it might be the best money managers actually have degrees in psychology in the next 15 years.
I bet they are. I bet the best money managers, the high net worth managers, I bet what they're really good at is taking people to dinner, calming them down, keeping them feeling safe and sleeping at night.
Just saying hold
investment like that. Why would this person be amazing at picking investments? It doesn't even make sense.
So we have the high net worth. I haven't heard of that one. So that's exciting. What are the enterprise use cases here where the JPMs, the Morgan Stanleys, some of them are probably doing it in house, but like how do they take advantage of this technology?
So one that we're doing is in this general high net worth space. Thinking about
you got a lot of rich friends, Matt. You just pull customers everywhere.
So I'm always trying to automate things that like. So this is if you work at MIT. Okay, if you work at MIT, you have a bunch of benefits, a 401k plan, emergency savings option plan, all these kind of things. If I want to speak to someone, says, hey, hey, Matt, I'll help you with your retirement planning or whatever, there's someone I can call. And so all of the kind of big boys of the world, Vanguard or Fidelity, they offer these services behind their kind of 401k plan. Now, they do it for essentially two reasons. One is they want to win the 401k mandate of the whole thing. And so they're sort of willing to offer a human being to talk to, super unscalable. Or in some cases, so by the way, this goes through all the way down to you're a 100-person company in the Midwest. You probably have some local kind of high net worth manager firm in town that does your 401k for everybody and is also willing to talk to people. And sometimes why are they doing that? A little for the 401k mandate, but sometimes even when they don't get that, they want it because when you call them and say, how much house can I afford? And then they say, oh, come move all your money. This is like prospecting for them.
Yeah, right.
And they're sort of happy to do this. Sort of happy. The reason I say sort of happy is one can only imagine how unscalable this is.
Right.
And what a disaster it is. And also, the same is true on the other side. If you've ever actually called this person to ask for help about your portfolio, they know nothing about you. They know nothing about your portfolio. They barely know what actually is available at MIT. I mean, they're reading it off a chart as fast as you're. So this is not like it's enormously helpful when you call this person. Again, actually, if you think about it for a second, okay, an AI should do that really well. First of all, they can learn a ton about you. Like as soon as you start interacting with them, they're in the background. I can know your banking situation. If you give me permission, I can know your banking. I can know your retirement situation. I can know and I know every single thing available for you at MIT because I got the whole, I got all of it, and I know what you're doing and not doing. So within a few minutes, I can say, hey, Matt, by the way, did you know there was an emergency savings plan option at MIT? And if you put money into it, they automatically add $1,000 into your emergency savings. Would you like to open that right now? And I'll do it for you. Okay. Did you know that there's a 401k matching plan and that you're currently not taking advantage of it? Would you like to alter your checking? Because I'll do it right now for you, rather than please fill out this paperwork for the rest of your life and and then we'll do it. Now, this person could be chatting with you and actually really knowing exactly what you're doing right and wrong today, helping you get focused on it. And by the way, when you start asking complicated questions about, how much house or whatever, hey, we are connected with this high net worth manager. We're happy that you should talk to John. He's great. So it can still be a sort of a marketing device for these firms, but a far less manual one that's far superior for all the kind of basic layer stuff, and then move it up.
Yeah, it's like rethinking of the operating system, right? Like, what is the AI native version that helps the human constrained process in a way that otherwise wasn't possible? And I think it's going to be an interesting race to see. This is going to be the classic Clay Christensen, right? Like, which of these large firms can't disrupt themselves because becoming AI native is going to kill their pricing model? Think Salesforce charging for seats, right? Like, and so
and the answer
are they going to
is,
disrupt themselves or not?
I really don't expect any of them to. Big companies are just sort of historically really bad at this, but they're super happy to just buy something to fill in when they have failed. So
it's almost certainly the better strategy.
but they need to try for themselves for a while. So they'll all try. They'll hire a bunch of people. They'll build some really bad internal version, and then they'll buy us. It's great.
And so you think that the probable exits for all these OSs is going to be like Vanguard, Salesforce, and they'll
a lot of them can just go right in. Slide right in. We think about that as one of our strategies is actually what can we build? Because anybody who thinks like the banking system's being disrupted is like lost it. I mean, like this is not good. This is not creative disruption where we're like completely getting rid of our financial firms. These things, there's a lot of reasons why they're sticking around. They're also smart. They're smart people there. They got plenty of money.
Yeah.
Fine. Let's just build for them the things they need anyway. And then win-win. We're happy to build it and sell it to them. They're happy to buy it from us. Great. So
in a way, you're speculating a little bit on the. And you guys are in a great position to do this on the acquisition market because you guys come in so early in the company life cycle, right? You can't necessarily make this acquisition bet at a Series B or a Series C because the opportunities in the markets to get an acquisition through politically are starting to approach a much lower number than traditionally. So
much harder. So people always make that mistake is they think, I have to sell for $8 billion. Well, it depends on where you invested.
Where's the sweet spot for you all that you're seeing, little regulatory scrutiny, but enough interest for our Fortune 500 or Russell 2000 to sort of be interested from a corp dev perspective?
From acquiring us?
Yeah, from a size or a scale,
Yeah, there's this like, they know it. They need to not kill us when they buy us. Yeah. That almost is what they're most scared of is that they'll buy us and immediately squish the company out of existence accidentally. Right?
Of
There's an elephant that you're sleeping next to. So they need us to be sort of robust enough as a firm that the firm, the day after they buy us, the year after they buy us, it just goes on its own.
Yeah.
So like the CEO of 55 IP, which we sold to JP Morgan, like he continues to run that business.
Yeah.
Inside of JP Morgan, he's the head of it, and they love it. He loves it. It's great. They've grown the business that works well together. It makes a ton of sense. That it already knew what it was doing when they bought it. If it's early and we're like figuring it out and we're having to completely twist and they're terrible at that. They don't do it. They never change in time. They waste tons of money in the wrong direction. So we need to get out of the we're figuring it out world and into the we need to repeat this over and over and over and over and over again. And then they actually get better than we are. They're much better at that sort of industrial get it done, right? Let's do it and not just do it once, but do it with 3,000 salespeople. Way better than we are. We don't need to be in that business. And
Give us a size or scale. Are we talking, 50 million a year in ARR? Is the sweet spot durable enough for them, or 10 million or 100 million? What makes
No,
sense for the big guys?
I think the ARR, all the ARR metrics are not really about ARR. They're about what the ARR signals, or
Right.
what information is really being conveyed. So if I say 1 million in ARR is good for a Series A, for example, or some, people say things like this. What you're really saying is that amount of ARR usually comes with a ton of information.
Yeah.
So if I said, oh, it's like 10 million ARR, but what the reality was I had one customer paying me 10 million of ARR, the answer is that conveys no information.
Yeah. Yeah. Yeah.
Except for that one customer really loves it. And like nobody's buying that firm in some sense unless they just really want that customer or something.
Yeah.
Whereas if I was selling things for, $10 a month and I had 10 million in ARR, oh my goodness, there must be a ton of information about how you're selling and how your repeatability and your go-to-market and your marketing. All these things would be so like, wow, you're good. So in some sense, it's not a 10 million of ARR.
Right.
It's, do you have a repeatable, scalable process with a lot of runway in front of you?
Yeah.
And if you have that, then they say, oh, great. I would say, where does that usually start? Like, why do they pay attention? When their salespeople pay attention. So if the sales team is like seeing something and wishes they were selling it, or is almost like telling people to buy it so that they can then, because we sell you this, but you need, like we sell a Wi-Fi thing that like really helps support your Wi-Fi. And we find that other people want to sell things that need your Wi-Fi. So they tell people, you should buy this because it supports your Wi-Fi, which makes our thing better. So then, of course, we do partnerships with Cisco or Zebra. Or so those are people that just, they really want you to have better Wi-Fi. So they push our thing. So that when you see their sales team like telling people to buy your thing, you're like, I think I know who's going to buy it.
I have never heard that one. I think that's probably the most tactically accurate advice around the tinglings of acquisition that I think I've heard to date. So that's fascinating. Any closing thoughts to the AI entrepreneurs out there that are getting started and they're building from someone that's been thinking about the space for a long time?
Whew.
No pressure.
Exciting. It's exciting out there. I mean, it is just an unbelievable opportunity, right? It's just an incredible time where we can answer the question, why now, so beautifully. So just really look for something that could not get done before, a problem, an issue, something that and there was just no way to solve it before. And now an LLM is probably not the whole answer, but now it can get solved. Yeah. And it's just this, you just have this opportunity, so go and do it. That won't be, again, that won't be here, right?
Right.
5 years from now, by 10 years particularly, all these things it's a little like the internet, right? Like at first you could tell anything, but then now there's Amazon and, you're not building a second one. So now is your moment for replacing everything essentially, but the key is things that really couldn't get done a different way. I see people starting things. It's like, well, we could have done that all before. It's a little better with an LLM overlay, but then the guy who has it already, he'll probably add an LLM overlay. So there's a lot of them are saying, well, everybody can get an LLM overlay. It's not that hard. Yeah. So where are you doing something that is sort of unlocked, possible now? And there's many, many options.
Yeah. Well, Matt, I really appreciate the time. We joke at, I went to HBS, but Sloan has the same thing where you calculate the cost of every class as an individual. I think it's like every student, if you do a tuition basis, is paying like $200 per that 1 hour session. And there's like 100 of us in there. And so if you think about like the value of your like hourly time in that session, like it's quite high. And so I feel very, very touched that you took a half hour and chatted AI with us. And we're excited to share this out with the world.
Absolutely happy to. Thanks for having me.
Cool. Thanks.